We're starting. We're good. Everyone ready? A little bit of computer issues is not going to stop us from getting this done. Thank you again. This is chapter 4 of financial accounting. What I love about this book is it really takes these first several chapters a little slower and breaks them up better than a lot of other books, because to me this is the hardest. This chapter is going to be the culmination of everything we've gone through, and then it's only going to get easier from here. But we're going to talk about the accounting cycle, and basically we are so close to finally, we've analyzed transactions, we've recorded them in journal entries, we've learned how to post them to the accounts. Then we created a trial balance where our debits equal our credits. And what's a debit? Left. And what's a credit?
Right.
And that's all it is. Some accounts, a debit increases the account. Some accounts, a debit decreases the account. It's just a matter of, is it an asset, a liability, owner's equity, revenue, or expenses? They're all handled a little different. So then we talked about adjusting journal entries. There are sometimes we have to record journal entries to get our books to match up with what's really going on. Like supplies. We purchase supplies, but we need to go and look and see how many we've used up. Or there might be work that we've completed we haven't billed for yet, so we need to show that. Or we might have insurance or rent that's been used up and we need to record that. You know what I'm talking about? Accrued and deferral entries. And then after that, we create what we call an adjusted trial balance. Are we all caught up? That's where we're at right now. So we are going to talk about this week what we do with that adjusted trial balance. We are going to prepare financial statements based on that adjusted trial balance. So for this week, we're going to start with, oh my gosh, I got the wrong slide up. That's managerial accounting, but the other one's coming, financial accounting. Okay. So this one got the right the financial accounting class here. Sorry about that. So we're going to talk now about what we do now that we have this adjusted trial balance. We know the goal of accounting is to ultimately to process the data, but to communicate the accounting information to the end user. The way we ultimately communicate it is through financial statements, because the end user will get those financial statements and be able to see, okay, what's the income that was earned this year? What are the costs, the expenses? How much debt does a company have? Where would they see the debt, the liabilities? On what financial statement? Wouldn't it be the balance sheet? We're going to learn all that today. So the way we communicate information to the end user are through financial statements. Here you see, it's kind of a small slide here, but you see this worksheet that showed our original trial balance, and then it showed all these adjustments we made, so then we can have what's called an adjusted trial balance. And it's from this adjusted trial balance, we're going to first prepare the income statement, then we're going to prepare the statement of owner's equity, and then from there we're going to create the balance sheet. Using the adjusted trial balance, the statements get prepared. Again, I said in the order, the income statement, the statement of owner's equity, and then the balance sheet. So the income statement has to be prepared first because we need to know the net income in order to then prepare the statement of owner's equity. And then we need to have the statement of owner's equity in order to prepare the balance sheet. So just know we always prepare them in that order, okay? Income statement first, then the statement of owner's equity, then the balance sheet. The income statement is prepared directly from the adjusted trial balance column on the spreadsheet. We start with fees earned or any earnings, and then we take all the expenses. Because we know in an income statement, the only thing that's on the income statement are revenues and expenses. The expenses in the income statement are listed in the order of size, beginning with the larger items. Miscellaneous expense is the last item, regardless of its amount. Then, when we deal with the statement of owner's equity, we take the beginning balances for the capital account, the individual Chris Clark. We add any investments that have happened that Chris Clark has added during the year. We add the net income, and we take the withdrawals that he's taken out or dividends he's taken out of the company for the year. After we do that and we have the ending balance of the owner's equity account, then we prepare the balance sheet. The balance sheet will come exactly from the adjusted trial balance. It'll show us our cash, all of our assets, all of our liabilities, but we'll get the owner's equity portion from the statement of owner's equity. Okay? So with a balance sheet, the balance sheet contains the accounting equation. Does anyone remember that equation? Assets equal plus stockholders' equity. That's a balance sheet. Assets, we know, are resources. Here it says they're the rights to economic benefits owned by the business. Assets are divided into two types. Current assets, which are usually assets that are going to be used up or converted to cash within the current year. Notes receivable and accounts receivable are amounts customers owe. So oftentimes, accounts receivable are always a current asset. Notes receivable, depending on when that note is going to be received, if it's within the current year, we treat it as a current asset. But if we're not going to receive that money within the current year, it's going to be a long-term asset, but the portion of that amount we're going to receive in this year will show as a current asset. Property, plant, and equipment can be termed fixed assets or plant assets. Mainly, no, current assets are those assets that are going to be used up or converted into cash within a year, where long-term assets, property, plant, and equipment, possibly notes receivable, they're going to have a useful life of greater than a year, okay? Liabilities and owner's equity. There are current liabilities. Those are liabilities that are due within a short time frame, usually less than a year. Think of this, payroll or salaries payable, that's going to be a current liability because as an employee, you better get paid within the year, right? Or within 10 days. Accounts payable is generally payable within 30 days. But things that would be considered long-term liabilities are things that are going to take over a year to pay off, such as a mortgage. Auto loans usually are 4 or 5 years. Does that make sense? So no, current liabilities are those that will be due or paid off within 1 year or less, where long-term liabilities are usually that amount that's due in greater than a year. The owner's right to the assets of a business is shown in the owner's equity section. The owner's equity gets added to liabilities because assets equal liabilities plus owner's equity. Statement of cash flows is another financial statement we'll talk about in greater length, but basically it can be prepared using this adjusted trial balance that everything else is being prepared from. And each cash transaction we classify. So the statement of cash flows only deals with items involving cash. And it will all be linked in either operating activities, which is why the company's in business, or financing activities is a way they borrow money or pay money back. And then investing activities is only the purchase and sale of long-term assets. Okay, that's it. The statement of cash flows is normally prepared using a different method. There's two methods in order to prepare it. This indirect method they're talking about, which we'll look at later, is a much easier method, but it's a little more convoluted. So that's something for down the road. Okay, guys, which of the following would not be considered a current asset? Land. Why?
Because you can sell right now.
Because the chances, the resource that land provides is going to last greater than a year. Okay? Let's look at this exercise right here. The balances for the accounts that follow appear on the adjusted trial balance columns of the end of the period spreadsheet. Indicate whether each account would flow into the income statement, the statement of stockholders' equity, or the balance sheet. Let's just look at the income statement first. The income statement has two types of accounts, revenues and expenses, and that's it. So do you see any revenues here? What would be a revenue?
Fees earned.
Fees earned. It's the only one I see. What do you see as expenses?
Utilities expense. Supplies.
Okay, look, the word will have expense after it.
Just 8 and 9.
Just 8 and 9. Guys, don't let this confuse you. Supplies is an asset until we use it up. Once we use it up, what do we call it? Supplies expense. The only thing in the income statement are revenues and expenses. If it does not have that word expense, don't put it in. Okay? So the three items in the income statement are fees earned and the two expense accounts. What would you see in here that goes in the statement of owner's equity? There's only one.
4.
Drawing, AJ drawing. Now, we also know AJ capital would be a part. And we also know net income would be a part, but that's not part of this group of accounts. So the only one here is AJ drawing. What about the balance sheet? The balance sheet has assets, liabilities, and owner's equity. So what it won't have are revenues and expenses, right? So assets, wouldn't we see number 2 and 3? Those are assets. Cash and accounts receivable. For liabilities, wouldn't we see number 1, accounts payable? Oh, excuse me, supplies is also an asset. I missed that one. For liabilities, wouldn't we see accounts payable? And then for owner's equity, the drawing account? Isn't that pretty much it?
And wages payable.
Thank you, wages payable also. Yes. Does that make sense? How you break it down. What's in an income statement? Revenue and expenses only. Okay? Only. Oh, unearned rent. Isn't that a liability also? Okay. Balances for each of the following accounts appear in adjusted trial balance. Identify each as an asset, liability, revenue, or expense. So guys, take a minute and look at this. And we're going to call them out. I'm going to say 1, what is it? 2, what is it? But take a moment and see if you can try to do it on your own. Again, the purpose of this class is to make mistakes and to learn. So don't beat yourself up. But I'm just trying to see if you can recognize them. Okay, guys. Number 1, what is this?
Assets.
An asset. Accounts receivable is an asset. Correct. Number 2,
Asset.
equipment is an asset. Number 3, revenue. Fees earned. Number 4, expense. Number 5, asset. Excellent, guys. Number 6, asset. Number 7, revenue. Number 8, expense. Number 9,
Liability.
guys, awesome. Number 10,
Asset.
number 11,
Expense.
number 12,
Liability.
awesome. Awesome. Do you understand that an expense only has the word
Expense.
expense? A payable or a liability will have the word payable after it except one of them. Unearned rent. Guys, unearned rent is a liability, but it doesn't have the word payable. It's the only one that doesn't. Don't forget that. Now, Paoli Consulting is a consulting firm owned and operated by Mary. The following end-of-period spreadsheet was prepared for the year ended March 31st. Based on the spreadsheet, prepare an income statement, statement of owner's equity, and balance sheet for Paoli Consulting. During the year ended March 31st, Mary invested an additional $15,000 into the business. So the one thing that we know, if you look, guys, it's probably hard to see, but do you see Mary Paoli Capital here? Do you see how it started with $1,960,000? Excuse me. And that's not what I wanted to say. So they're letting us know that she invested $15,000 more into the business. We're going to have to take that into account, okay? It's not showing it on here, but we're going to have to report it as part of the information. This form here, we start by preparing an income statement. Do you see all of the income statement accounts are here? Our assets, our liabilities, our drawing, our equity is all up here, but our income statement accounts are down here. So it's kind of easy to figure out where we create the income statement. We start with fees earned, and then we go to the salaries expense, supplies expense, depreciation expense, and miscellaneous expense. The Mary Paoli additional $15,000, if we had the previous year's adjusted trial balance, we would notice that would have been $15,000 the capital account would have been 15,000 less than this one is right here. Okay? Because during the year she invested the 15,000. She didn't do it as an adjusting entry. So to create the income statement, we're just going to take those bottom accounts. You see, we've got our fees earned, and then we've got our expenses, and from there we have our net income. Do you see that? It's that easy. One thing important is on an income statement, we show the name of the firm. We say it's an income statement for the year ending March 31st, 2029. Or if it's for the month ending, we'll say for the month ending March 31st, 2029. Clearly, this consulting company has a fiscal year of April 1st through March 31st. Does that make sense? Now that we have the income statement, we have the income statement showing net income of $665,000. We need that number to put into the owner's equity statement. Do you see up here with the owner's equity statement, we took Mary Paoli. If you looked at what her beginning balance was at the beginning of the year, it would be $15,000 less than what we're showing. So from the previous year, we would have shown $1,945,000 would have been her beginning balance. It told us she invested $15,000 during the year. So we would show that as an additional investment. Then we would bring over the net income from the income statement. And then if she had any withdrawals, which do you see we know she did because it says Mary Paoli drawing of $30,000. We subtract that to come up with her ending balance at the end of the period would be $2,595,000. So we'll start with her beginning balance. Now, the reason we know her beginning balance was $15,000 less is because they told us that she had invested an additional $15,000 into the company, right? We then add her drawings, add the net income, add her investment, add the net income, subtract the drawings that they took out, and we come up with an ending balance. This ending balance of $2,595,000, we need that number because do you see down here, it flows into the balance sheet, the $2,595,000. Do you see that? $2,595,000. So we get that information from the statement of owner's equity to put in the balance sheet. Everything else in the balance sheet, we break down by current assets, or we break down into property, plant, and equipment. There are a bunch of other categories, but for now we're going to keep it straightforward there. We show our current assets, cash, accounts receivable, and supplies, and then we total them. We take our long-term assets, the property, plant, and equipment, the land, the building. Do you see how we subtract out that accumulated depreciation there, guys? Because remember, the building minus that accumulated depreciation gives us our net figure in our asset. And we total the total property, plant, and equipment. So all of our assets there show $2,650,000. We then take our liabilities. In this case, we only have current liabilities. We only have an accounts payable and a salaries payable that total $55,000. If we then take the Mary Paoli capital, and we add those together, don't our assets equal our liabilities plus our owner's equity? Make sense? Yes? Am I confusing you? Let's try another one. Triton Consulting is a consulting firm owned and operated by Jason Neese. The following end-of-period spreadsheet was prepared for the year ended April 30th, 2023. Prepare an income statement, statement of owner's equity, and balance sheet for Triton Consulting. It's telling us during the year Jason invested an additional $5,000 in the business. So we know, guys, his capital account's going to be $5,000 lower, right? So now what we do is we think, okay, we are going to use this adjusted trial balance over here to create our income statement. Do you see we're going to start with our fees earned and take all of our expenses, and they're all right in this category right here? So we'll show our fees earned, all of our expenses, and our net income is $32,450. And how do we know it's an expense? Because it has the word expense after it, okay? Then we come up with the net income. In this case, the net income is $32,450. We need that net income in order to calculate the statement of stock of owner's equity. We show Jason started with $67,200. Now, guys, this says $72,200, but we know during the year he invested an additional $5,000, right? So we show what he started with. We show an additional investment by owner. We add the income, the net income. We subtract the drawings, and we can tell he had how much in drawings, guys? $10,000. You see there? To show our Jason Neese capital account at the end of the year is $94,650. Does that make sense? We need the statement of owner's equity in order to complete the balance sheet. So in the balance sheet, we're going to take all of our assets. We're going to start with our current assets: cash, accounts receivable, and supplies. See, current assets, cash, account receivable, supplies. We total our current assets. Then we take our property, plant, and equipment, which will be office equipment, the accumulated depreciation. We keep them together. And that's it. That's it. That's all we have for assets, property, plant, and equipment. We total our assets. They equal $100,000. Assets equal
liabilities plus owner's equity.
Just remember that, okay? That's what the balance sheet is. We look at our liabilities, and all we have are two current liabilities: accounts payable and salaries payable. You see where we got those? Accounts payable, salaries payable. Then we take the owner's equity section from the previous statement, the statement of owner's equity, and do our assets equal our liabilities plus our stockholders' equity? Yes. Is it kind of clicking? Now, let's just do one on owner's equity. Climate Control Systems offers its services to residents in the Spokane area. Selected accounts from the ledger of Climate Control Systems for the fiscal year ended December 31st, 2022 are shown to the right. Prepare a statement of owner's equity. So we show that we've got the capital account. We show it began with $4,225,800. Do you see that? Then it looks like something happened, something increased the capital account on February 15th, which was probably an investment. Wouldn't that make sense? And then do you see on December 31st, something increased it? That was probably the net income, right? And then do you see that we've got all these drawings that happened during the period? I think I might have messed up a zero you can't see there, but you see all these drawings that happened during the period, what he took out. So as you see here, we started with 4,225,800, which is how we began the T account. You see that there. We show he invested an additional $25,000 into the company on February 15th. You see the net income during the year is $700,000. And I saw that because of this December 31st, $700,000. The net income flows into his drawing account or capital account. And then he took out $160,000. Do you see here? 40, 40, 40, and 40? 160. So we know then his ending balance. What this exercise is supposed to help you see is if you look at his account, you can see what it began with, if he added anything to it, what the net income is at the end of the period, and then the drawings, what he took out. Okay? Make sense? Identify each of the following here as a current asset or a property, plant, and equipment. I'm going to let you take a couple of minutes and look at these. Is this helpful, guys? I just find for me, even still, the only way I really grasp the concepts is to do problems, because you can get the concepts in your head, but it really doesn't play out until you do it. So we're going to break these up. Assets that can be converted to cash within a year or less, or those resources that are going to last us greater than a year. What do you think number one is? Accounts receivable. Current. Building. It better last more than 1 year, right? Cash. Cash is always current. It's always cash is as liquid as you can get. Equipment. Prepaid insurance. Current. Supplies. Excellent. At the balance sheet date, a business owes a mortgage note payable of $375,000, the terms of which provide monthly payments of $1,250. Explain how the liability should be classified on the balance sheet. Yes.
So if you have equipment that you're planning on selling within the next year, would that be considered a current asset, or would it still be considered property?
It would still be considered property, plant, and equipment. I understand what you're saying, and technically it should be a current asset from a technical standpoint. If you know you're getting ready to sell it, you're right. I've just never seen that on someone's books. But what you're saying, if you know it's going to be converted to cash within the current year, it would be a current asset. You're right. This is, yes?
Just out of curiosity, with prepaid insurance, this might make no sense at all, but let's say you pay for it for 2 years, would that still be considered a current asset in the future?
It's a current asset because if you needed to, you could convert it to cash within a year. Okay, I get where you're coming from because you know it's going to go over a 2-year period.
Right.
In this scenario, the portion of a mortgage that is going to be paid within the current period, the current year, is going to be considered a current liability. So if the note of $1,250, 12 months of it, is $15,000, the portion of this $375,000, the $15,000 of it will be considered a current asset because we know we have a current liability because we know we have to pay that portion in the current year. So that will be a current liability. The rest, the $375,000 less the $15,000 or the $360,000 will be a long-term liability because that is not going to be paid within the current period. Does that make sense? Let's look at this one. Easy Weight Loss Consulting offers personal weight reduction consulting services to individuals. After all the accounts have been closed on November 30th, 2027, the end of the fiscal year, the balances of the selected accounts from the ledger of Easy Weight Loss are as follows. Prepare a classified balance sheet that includes the correct balance for cash. So do you see what they're doing? Cash is a question mark because they want us to figure out what cash is because we know that assets equal. Does that make sense? So we're going to take, we don't know cash yet, okay? Let's pretend we don't see that number. But we're going to put in our prepaid insurance of $7,500, our prepaid rent of $4,800. We're going to put in our supplies of $9,150 and our accounts receivable of $130,550. That's all we know for assets, isn't it? Then we're going to put in our liabilities. Our current liabilities, accounts payable of $41,200. Excuse me, guys, I forgot something. In the assets, we have equipment of $230 and accumulated depreciation of $4,500, right? So we have to put that in along with our land. So we have our current assets, and then our property, plant, and equipment would be our land of $320, our equipment of $230, minus our accumulated depreciation of $45,000. So we have that number too. But we're missing total assets because we don't know cash, right? Then we see our liabilities. Our accounts payable is $41,200. Our salaries payable is $3,800. And our unearned fees, remember that liability that's a little sneaky? Unearned fees is still a liability, but it doesn't have the word payable after it, right? Yes? So we have our total liabilities of $58,500. We know that our Quinlan, they show us $691,500. Can't we total our liabilities plus our owner's equity to see what the total is? And we know that needs to be our assets total, which then we can figure out what cash should be. Does that make sense? So that's how the $93,000 came about. Okay? Because our assets have to always equal our liabilities plus our stockholders' equity. Any questions on this? Are you guys good? The balance sheet was prepared by Labyrinth Consulting Services. I hate these. List the errors and prepare a correct one. Well, I'm just going to show you the errors. The date of the statement should be August 31st and not for the year ended August 31st. So a balance sheet is a snapshot in time. An income statement will always say for the year ended because it's a series of all the revenues for the period and all the expenses for the period. But a balance sheet is just a date because remember, it's a snapshot because the next moment something else could change. What I mean by that is The cash sitting on August 31st is $18,500. On September 1st, you could pay $20,000 of bills, or let me just be $18,000 of bills, and you only have $500 in the cash account. Am I making sense? It's a snapshot. It's just at this one moment in time because it could change tomorrow. Do you understand what I'm trying to get at? Accounts payable in here shows, where is accounts payable? Accounts payable sitting up there in current assets. Can you guys see that okay, or is it hard to see? Accounts payable is not a current asset. Isn't it a current liability? Land. Land is sitting up as a current asset. What is land? Property, plant, and equipment. Accumulated depreciation should be deducted from the related fixed asset. Accumulated depreciation, do you see how they're sitting down there in current liabilities? But they really should be, accumulated depreciation of building should be attached to the building. And accumulated depreciation equipment should be attached right below the equipment to get the net property, plant, and equipment, right? Kind of like here. Do you see where you see the equipment and then you see the accumulated depreciation equipment? Do you see how they net out? That's how it should be. Accounts receivable should be a current asset. They have it as a current liability. Net income should be reported on the income statement and statement of stockholder or owner's equity. They have net income sitting on here in current liabilities. Wages payable should be a current liability. It's not part of owner's equity. Okay? So basically, the corrected statement shows our current assets, cash, accounts receivable, supplies, and prepaid insurance. Our property, plant, and equipment includes the land and the building. Accumulated depreciation gets subtracted from the building. And then our equipment, the accumulated depreciation on the equipment gets subtracted. And we have our total assets. Then we have only two liabilities, accounts payable and wages payable. And then our Tanya Egan capital. Okay? Make sense? Whoops. Okay. So we've gone through the process of finally preparing an adjusted trial balance, and we know all of our financial statements are going to come from that adjusted trial balance. We're going to start first with the, what statement comes first? Income statement. Then we do the statement of owner's equity. Then lastly, we prepare the balance sheet. Okay, now what? Okay, we did our financial statements, but guess what? We need to close out our books so we get them ready for the next period. So, closing entries, when we're dealing with our net income, we're going to flow that into our owner's equity, but we need to get rid of our temporary accounts so we can start fresh again. Permanent accounts are what we call real accounts, are those that are on the balance sheet. They never go away. What our cash is on December 31st, don't we start January 1st with that same cash? It doesn't go away. Accounts receivable is the same. Buildings the same. Our liabilities are the same. Our capital accounts the same. We call all the accounts in the balance sheet permanent accounts. They're etched in stone. They're not going to go away. But what we are going to look at are these temporary accounts that we need to zero out to start the next year fresh. Temporary accounts do not get carried forward into the new period. They get wiped out so we can start fresh. At the beginning of the next period, temporary accounts should all have zero balances. So in order to do this, the temporary account balances get transferred to permanent accounts at the end of the accounting period. Now, guys, if you think about it, our income statement accounts, our revenues minus expenses, give us what? Net income. What do we do with that net income? Don't we transfer it to the capital account, the owner's equity? Do you see in a way that's how we're getting rid, or we're zeroing out those accounts? Because at the end of the period, we come up with either net income or a net loss, and we flow that to the capital account. Okay? So the journal entry that transfers all of these balances of these temporary accounts, we're going to call the closing process. The way we do it is the revenue expense account balances get transferred to the owner's capital account. And then the balance of the owner's drawing account is transferred to the owner's capital account. 2 closing journal entries we need to do. Revenues have a normal credit balance. To zero them out, we will debit each of those revenue accounts, and we will credit the owner's capital account for those revenues to flow in there. Then all of the expense accounts have a normal debit balance. But if we credit every one of those expense accounts to zero them out, and we end up debiting the owner's capital account, do you see in essence net income flows into the owner's capital account? Then we will debit the owner's capital account for the balance of the owner's drawing account. So if during the year the owner had drawings of $50,000, to zero out that drawing account, because that is also a temporary account, even though it's not in the income statement, that is also the other temporary account. We zero out that drawing account so we can start fresh for the next year. Closing entries are recorded in the journal as the last day of the accounting period. So what we're doing here, guys, all expense accounts normally have a debit balance, but we're going to credit them. And we're going to credit them to wipe them out. Expenses have normally, here's the revenue accounts. They have a normal credit balance. I said that wrong. And we're going to debit them. Expenses have a normal debit balance, but we're going to credit them. And we wipe them out and basically take the net income, because the revenues minus the expenses equal the net income. And we're going to take that net income or net loss and flow that into, the capital account of the owner. We're also going to take any drawings the owner has made during the period, which has a normal debit account, and we'll credit that and debit that to the owner's capital account. In essence, think of the statement of owner's equity. That's what we're doing there, aren't we? We're showing the net income flows back to the owner's equity, and we're showing the drawings reduce the owner's equity account. Here, we could be as simple as taking every single expense account and zeroing it out. We can take the revenue accounts, zero them out. we take the drawing account, zero it out. So you see here, ultimately, when we take the revenue accounts, zero them out, and the expense accounts and zero that out, basically the net income flows into the capital account of the owner. Okay? Then when we zero out the drawing account, that gets debited to the owner. So these closing entries debit each revenue account, credit each expense account, we'll credit the net income, or we debit the net loss to the owner's capital account, and then we'd also debit the owner's capital account for the drawings that were taken during the year. And what that does, those closing entries zero out all revenues, all expenses, and the drawing account. So we start the next period with the zero balances in only the temporary accounts. Okay? Here you see the actual journal entry. We debit our fees earned. We debit our rent revenue. Those are our two rent accounts or income accounts. We credit all of our expenses. And do you see we also credit Clark Capital for the net income? See what we're doing? We're debiting our revenue accounts. We're crediting all of our expenses. And the net income of $7105 gets credited into the Clark Capital account. We're also zeroing out our drawings by debiting Chris Clark Capital and crediting the Chris Clark drawing account. Okay? Here you see the closing entries. They show our permanent accounts don't close out. Our cash, our accounts receivable, our supplies, our prepaid insurance, our land, office equipment, accumulated depreciation on office equipment, accounts payable, wages payable, unearned rent, they have their ending balances. Those are balance sheet accounts. They are permanent accounts. Chris Clark Capital was adjusted because we took our revenue and expense and drawing accounts and zeroed that out into Chris Clark Capital. But do you see our drawing account is now zero? Our fees earned is now zero. Our rent revenue is now zero. Our wages expense is now zero. All expense accounts are now zero. We are ready to begin the next period by temporary accounts all going to zero and all the permanent accounts stay the way they are. And the only account that was adjusted was into the capital account. Okay? That's closing the books so we can start the next period. Here, you know how when we started, we did a trial balance. Then we made adjustments and we did an adjusted trial balance. Here is the post-closing trial balance. And do you see in the post-closing trial balance, you will only see balance sheet accounts. You don't see any revenue accounts. You don't see any expense accounts, or you won't see a drawing account either, because those have all been zeroed out to start the next period. This here is called a post-closing trial balance. Okay? Which of the following would be considered a nominal account rather than a real account? Nominal meaning temporary account rather than a real account? Rent expense. Accounts receivable, accounts payable, and cash are all balance sheet accounts, which are permanent accounts. Okay, guys, we're going to look at these various accounts, and we're going to identify Which of these accounts need to be closed out at the end of the period? Remember, the ones that are closed out are revenue accounts, expense accounts, and the drawing account. Okay? So which of these need to be closed out? That's a liability. Liabilities don't get closed out. Okay? Let's think about what's on the balance sheet. Assets equal. That will never get closed out. The only ones that get zeroed out are on the income statement and the drawing account. So wouldn't E be a revenue account? Wouldn't H be a drawing account? That gets closed out. It's not on the income statement, but it gets closed out. What else gets closed out? J, K, and L. Is that making sense? Automation Technology Services offers its services to companies desiring to use technology to improve their operations. After the accounts have been adjusted at December 31st, the end of the fiscal year, the following balances were taken from the ledger of Automation Technology Services. Journalize the closing entries. So what will we do to zero out those temporary or nominal accounts? Fees earned, we need to zero out. Rent expense will zero out. Supplies expense, wages expense, and miscellaneous expense will zero out our income statement. We also need to zero out the drawing account or close the drawing account, right? So, do you see fees earned normally has a credit balance, but to zero it, we're going to debit it. All the expenses normally have debit balances, but to zero them out, we're going to credit them. And either profit or loss is going to go right into JM Hale Capital. In this case, the net income is $127,600, right? That's going into Hale Capital. Now, Hale took $45,000 of drawing. You see how we're zeroing that out? We're reducing the capital account of $45,000. So at the end of the period, do you see we're zeroing out all those temporary accounts to start fresh the next period? And where do we put them? We put everything into the capital account to start over again. Okay? What are the permanent accounts? Which of these accounts will appear on the post-closing trial balance because we do not zero them out? Assets equal. Are you getting sick of me? But do you see how sometimes, like, it works, that repetition? I just don't want you waking up in the middle of the night going, God, that bitch. I'm still saying this assets equal. You get what I'm saying. Sorry. Sorry, anyone that's listening to this. But you understand the point, okay? Assets are permanent accounts. Liabilities are permanent accounts. And owner's equity is a permanent account. They are not going to get closed out. So which of these are permanent accounts? A, B, C, E, H, K. Yay. You got to have fun when you learn. Do you ever go into classes and it's just like, oh, God, I dread it? You're probably thinking you dread it too, but I got to make it a little fun. Okay. Now, an accountant prepared a post-closing trial balance. Prepare a corrected post-closing trial balance. Assume that all accounts have normal balances and that the amounts shown are correct. This is a post-closing trial balance, but this chick got her debits and credits messed up. What looks wrong here, guys?
Supplies and equipment are credit balance.
And they should be debit balances, right? And accumulated depreciation should be a credit balance. Unearned rent, what is that? A liability. What is it normally? A credit balance, isn't it? And Sean, capital should be a credit balance. So guys, the key here is that you need to know assets have normal debit balances because they're on that left side of the equation. Liabilities and owner's equity have normal credit balances. So we know all assets should have a debit balance. The contra account accumulated depreciation is going to have a credit balance. And then our liabilities and stock owner's equity has a credit balance. So they're all goofed up here. Look at their balances. Debit balances are 706, credit balances are 123. So if we did it correctly, our debits stay on the left, our credits are on the right. Do you see how we balance now? Make sense? How you doing? Now, you hear of this accounting cycle. An accounting cycle, we've done it. We've completed it already. This is the process we use in accounting. We begin by analyzing transactions and we journalize them to the ledger. And after we journalize them, we post them to the accounts. We prepare a trial balance. We create adjusting entries. Then we create an adjusted trial balance. We then create financial statements. We then create closing entries, and we have a post-closing trial balance. That is the accounting cycle, and it happens every year. It's the same process every year. Does that make sense? That's how accounting works. We use this accounting cycle to record transactions. We analyze them. We figure out what accounts are being affected. Remember me talking about that in week 1? And then we record them. Then we learn how to take all those journal entries and post them to the various accounts they belong to. Then we create a trial balance where our debits better equal our credits. Then we look and say, okay, I think some accounts need to be adjusted here. We adjust them and we create an adjusted trial balance. That's the adjusted trial balance we use to get our income statement, statement of owner's equity, and our balance sheet. Once we've done those, we want to zero out our temporary accounts so we can start next year the same. Got it? It's that simple. It really is. Basically, we started with chapter 1 where we learned about that most important equation you're going to dream about. Then we talked about the accounting cycle where we analyze transactions, and every journal entry, our debits must equal our credits. And we created journal entries and then we posted them to the various accounts. Then we talked about adjusting entries, those transactions that happened, but we just didn't record them due to various reasons. Then we're preparing financial statements based on that adjusted trial balance. We've created the financial statements. It's time to zero out those accounts, nominal accounts, temporary accounts, so we can start the next period. And we're ready to start the next period. Okay? So the steps in the accounting cycle are listed here, but we need to put them in the right order. Can you guys help me put them in the right order? What do we start with? I's the first. I is transactions are analyzed and recorded. Yes. What's next? right below it. J. They're posted to the ledger. Then what's next? Oh, sorry, I screwed that up. I have two G's. It's really F. An adjusted trial balance is prepared, right? Sorry, guys. Then what's next?
C.
B. Adjustment data is assembled and analyzed. And then an adjusted trial balance is done, correct? Then C. No, adjusting entries are journalized, and then we prepare an adjusting trial balance, right? We haven't done D. D. Then what? We prepare financial statements. H. Then, don't we want to do our closing entries? Right? And then we have a post-closing trial balance. The one in here, an optional end-of-period spreadsheet is prepared. We never really talked about that. We can do that in between posting the trial balance, then our adjusting entries, and the adjusted trial balance. But basically, the steps are analyze transactions, post them, prepare a trial balance, gather what needs to be adjusted, prepare the adjusting entries, prepare an adjusted trial balance, prepare financial statements, prepare the closing entries, and a post-closing trial balance. Make sense? In this section, we're showing the entire accounting cycle for Kelly Pitney. She's got a part-time consulting business. On April 1st, 2028, Kelly decided to move to rented quarters and to operate the business on a full-time basis. The first step in the accounting cycle is to analyze and record transactions in the journal using that double entry system. We record transactions. We carefully read the description of the transaction to decide, is it an asset, a liability, owner's equity, revenue account, or expense accounts. And then for each account, we determine whether the account increases or the account decreases. Then we determine with each increase or decrease, is it a debit or a credit? So based on what type of account it is, it may be a debit. Based on the account, it may be a credit. We record the journal entry, but our debits will always equal our credits with every journal entry, right? Then we have a chart of accounts. Each transaction has to go into one of these accounts, right? After we do that, we prepare a journal entry, all the journal entries, then we end up posting all of those journal entries to the various accounts. We put in the date, we put in the amount, and we show, is it a debit or a credit? After we do that, we then prepare what we call an unadjusted trial balance. All it shows is our debits equal our credits. There could still be mistakes on the trial balance because we could have journalized something wrong, okay? But our debits just equal our credits. Then, after we prepare this unadjusted trial balance, we need to then go and look at possible adjusting entries. Before the financial statements can be prepared, the accounts must be updated. The 4 types of accounts that normally require adjustments include accrued revenues, accrued expenses, unearned revenues, and prepaid expenses, along with depreciation we may need to look at. So we sit there and we look at various transactions we need to adjust. In here, we had some insurance that expired. So we need to figure out how much is insurance expense versus prepaid insurance. We need to look at supplies and see how much we've used up during the period. We need to record depreciation on certain assets. The salary of the receptionist, she incurred some money in this period, but she's not getting paid till the next period. So we need to show that as an expense and a payable. We had some rent that expired, we need to show. And we had a liability called unearned fees that we've earned some of it. So all of these are adjusting entries we need to fix. You can use a spreadsheet to then show the trial balance, the adjustments, and adjusted trial balance. Again, when you're using software, this is all done for you, okay? Then we should look at our spreadsheet showing our initial balance, what adjustments we're making to come up with our adjusted trial balance. We then post those adjusting entries to finally have an adjusted trial balance. It's from this adjusted trial balance we prepare our financial statements. We start with our income statement, then we do our owner's equity, then we do our balance sheet. Once we do those statements, we then need to close our temporary accounts. Our temporary accounts is everything on the income statement, revenues, expenses, and our drawing. All of those zero out and we put them into the capital account. Here you see the revenues zeroing out and all of our expenses zeroing out, and the net income flows into the capital account. Below, you see the drawing is zeroed out, and that amount that the owner took out reduces his capital account by debiting it. Once we've done that, we will finally prepare a post-closing trial balance, and this post-closing trial balance only shows permanent accounts, which are assets, liabilities, and stockholders' equity, the capital account. Guys, it's that simple. Here are our financial statements. Am I going backwards or forwards here? Which of the following accounts would not be listed on a post-closing trial balance? Fees earned. Why? Yes, it's a revenue account. Why is the accrual basis of accounting required by generally accepted accounting principles? To understand why the accrual basis is required, we need to figure out what the alternative is. The alternative would be cash basis of accounting, which means we only record transactions involving cash, which means we would only show income when cash came in, or we'd only show expenses when cash was paid out. But we're not matching and really showing what really happened during the period. Because sometimes we can earn income even though we didn't yet receive it, or we can have expenses that we actually didn't pay. And so we want to make sure we're matching our revenues along with the costs that were incurred to make them. The accrual basis of accounting uses the revenue and expense recognition principles to record revenues and expenses. Revenues are recorded when earned, which is when the services have been performed or the products have been delivered. Under the expense recognition principle, which we call the matching principle, the expenses incurred in generating revenues are recorded in the same period as the related revenues. Make sense? So if you have the accrual basis of accounting, we record revenues when they're earned, and we record expenses when they're incurred. In this scenario with Net Solutions, we show the financial statement using the accrual basis, and then we show a financial statement using the cash basis, meaning only when the revenue comes in as cash or when the expenses are paid out as cash. Do you see in this scenario, we've got some changes here. We have supplies expense that shows $800 on our income statement accrual, but on our cash basis statement, we show this supplies expense when we paid for the supplies and we write it all off. Under the accrual, we don't write that off as a supplies expense until we use it up. Does that make sense? That's the only difference between these two slides. Wait, what is this one? For Net Solutions here, if we look at the accrual versus the cash, under the accrual, we record revenues when we earn them, not just when we receive them. So here, our fees earned and our rent revenue is a lot higher than under the cash basis. Under the expenses, we've got some differences. We probably had some prepaid insurance. Under the accrual, we showed as an asset. But here under the cash basis, since we paid for $2,400 worth of insurance expense, we just wrote it all off at once. Or our wages expense, we only reported wages expense when we paid them. But under the accrual basis, we could have accrued some wages because they were incurred in this period, even though they weren't paid in that period. Our rent expense is the same. Our utility expense is the same. Miscellaneous is the same. Under the accrual basis, we show something called depreciation. We accumulate and record that use of an asset over its useful life. I think that's everything. So basically, the accrual basis is going to give us different numbers than the cash basis, but it is more accurate and it more reflects what's going on in the business. Depending on the manner in which you report, in this scenario, if you try to analyze the financial statements based on the cash basis of accounting, then it looks like Net Solutions is in a lot of trouble, okay? Because we're not really reflecting the expenses associated with the assets. Let's look at this one. Net Solutions reported December accrual net income in that Exhibit 20 of $4,055, where under the cash basis, we would have shown a loss. And so basically, why are the accrual and cash basis net incomes different? Accrual, we report income when we earn it, or we've delivered the products. Under the cash basis, we only record income when we receive it. Okay? With the company, they report it as an expense when they pay the bill. We only report things as an expense when they've been incurred. So if under the cash basis of accounting, you pay $6,000 of rent for the whole year, they would write that all off as rent expense, okay, in 1 month, where we would show that as a prepaid rent and take a portion of that rent as it's passed in time. Does that make sense? Same with supplies, same with insurance. And ultimately, the accrual basis of accounting is required by generally accepted accounting principles. I think it makes sense what I'm trying to say. Now, The ability to convert assets into cash, we call it liquidity. Okay? One reason many companies could be extremely beneficial and profitable, but go bankrupt is they don't have enough cash on hand to pay their bills when they come due. The ability of a business to pay its debts is called solvency. You can have great ideas, you can even make money, but if you're not getting the money in order to pay your bills, are you going to stay in business? So liquidity is crucial for a company. You're not going to have employees if you don't pay them on time. Two financial measures for evaluating the business's short-term liquidity and solvency we call working capital and the current ratio. Basically, working capital is current assets minus current liabilities. Are our current assets greater than our current liabilities? They need to be. Current assets are more liquid than long-term assets because they can be readily turned into cash to help pay your bills. A positive working capital means that the business is able to pay its bills, which is a beautiful thing. So no, you can figure out what your working capital is by just your current assets minus your current liabilities. It's that simple. Another thing you might hear a lot about, there's a lot of ratios, but the current ratio is current assets divided by current liabilities. The current ratio here is usually, you hear about it much more than you will working capital when investors are trying to analyze various companies. Know that ratios are helpful, and we're going to learn about some at the very end of the course, one of the last chapters. But ratios are really important in helping to just be able to analyze the information that comes from financial statements. I think that's pretty much everything I want to cover. There are a couple of, we'll go through one of these exercises. Alert Security Services offers security services to business clients. The trial balance is shown here. And then we have some adjustments that we kind of talked about last week. And what they want us to do is on this spreadsheet, put in the adjustments and then show an adjusted trial balance. So here we're going to adjust fees earned but not yet billed. What do we do when we have fees that were earned and not yet billed? We'll debit accounts receivable and we credit fees earned. When we have supplies on hand of $4, but we showed in here our supplies were $8, what are we going to do? Where did I just screw up? Yeah, we're going to debit supplies expense and then credit supplies, okay? Insurance premium that expired were $10. We'll debit insurance expense. We'll credit prepaid insurance. Depreciation expense of $3. We debit depreciation expense, credit accumulated. Wages accrued but not paid of $1. We would debit wage expense and credit wages payable. So basically, what they want us to do is show all those adjustments in here, create then an adjusted trial balance, and it's from that adjusted trial balance then that we'll create our income statements. So here's another one that shows it. And then this exercise here shows from our adjusted trial balance how we're creating our income statements, just what we did earlier. Okay? Are there any questions regarding this chapter? How's everyone?